Hello everyone, this is Uncle Longlek. Welcome to my channel. In this channel, we'll be talking about financial market and crypto economics. If you like these topics, make sure to subscribe for more. Alright, let's begin. Last time, we talked about fundamentals of derivatives. In this episode, we'll be talking about crypto derivatives and its basics. So let's start with the history of crypto derivatives. Comparing to a long history of traditional markets, the crypto market is fairly young and nascent. Before 2017, there were barely any derivatives on crypto assets being traded. During the 2017 ICO boom, the crypto markets caught the attention of the entire world, and people saw an influx of capital and demands for more derivative products. And since then, the crypto derivatives market has blossomed. It has been growing at net-breaking speed in recent years. Currently, there were almost $200 billion worth of crypto volume being traded every day, spread over tens of different exchanges, and the market trades 24/7 non-stop. Speaking the history of crypto markets, we have to mention BitMEX, the largest crypto derivatives exchange just a few years ago. In 2018 and 2019, BitMEX was handling over 70% of the entire market share of crypto derivatives, but they have gradually lost market dominance due to new competitors coming into the fray, such as Binance and FTX. But how did BitMEX come into prominence in the early days of crypto derivatives? Well, besides being the only place where you can trade leveraged products, they have made really interesting adaptations of traditional financial derivatives, namely the inverse perpetual swaps. Last time we talked about swap. Swap is a type of financial product where one party gives the other a floating amount periodically while receiving a fixed amount when the contract expires. But as for perpetual swaps, contracts where both parties agrees to pay or receive interests periodically to each other into perpetuity, meaning there is no expiry date. Therefore, when two parties enter a perpetual swap, they are both receiving or paying a floating amount periodically into perpetuity, meaning the swaps last forever. So the periodical payment also lasts forever. But how much does one such contract worth and how is it structured? Well, the structure of a perpetual swap varies from exchange to exchange, but normally it more or less follows the following form. The interest rate is determined by the difference between the market price of the contract market and the market price of the underlying Bitcoin market. The interest rate can be a fixed interest rate based on prior market dynamics, or a floating interest rate based on current market dynamics. The rate is determined with a complicated algorithm to quantify market premium or discount. But basically, if there are more buyers than sellers, the rate will stay positive, and the buyers of perpetual contract will pay interest to the sellers and vice versa. For example, on BitMEX and many other exchanges, the perpetual swap interest is determined by the average supply and demand dynamics of the perpetual contract market. Let's say from this moment until 8 hours from now, the market demand for perpetual contract is much higher than supply. Then the perpetual market may be trading at a premium than the Bitcoin spot market. Then to keep price in line, the buyer will have to pay seller's interest rate at 16 hours from now. And that interest rate is determined during this 8-hour period. We also mentioned that the innovation from BitMEX is not just perpetual swap, but actually inverse perpetual swap. What does this inverse imply? Back in 2017 or earlier, it was really difficult to trade with real dollars on crypto exchanges due to regulations and laws. So to circumvent the regulation, BitMEX made a slight modification to the swap contract. Instead of exchanging dollars based on the price of Bitcoin per dollar, the contract allows people to exchange Bitcoin based on the price of dollar per Bitcoin, hence the term inverse. The underlying of one normal contract would be 1 Bitcoin, or a linear multiplier of 1 Bitcoin. But for an inverse contract, the underlying of one contract represents $1. So when one trader buys 100 contracts from the other, the trader will have brought $100 and have the liability to give the sellers $100 worth of Bitcoin. See the difference? A normal contract would allow you to exchange 1 Bitcoin at expiry, but an inverse contract exchanges $100 worth of Bitcoin at expiry. And because of this, the profit and loss in the accounting unit, which is Bitcoin, is not linear like a normal contract. There's innate convexity of it. Imagine the moment you brought $100 worth of contracts, Bitcoin worth $100. Your total liability is now 1 Bitcoin. But if Bitcoin drops to $1, your total liability increased to 100 Bitcoins. On the other hand, if Bitcoin rises to $200, your total liability is now only 0.5 Bitcoin. Well, this may be a bit complicated for beginners, but as we dive deeper into the crypto lands together, you will eventually get a hand of it. That's all for today. Thanks for watching, and we'll be talking more about margin and leverage in crypto markets in the next episode. See you next time.